Live from Bloomberg's world headquarters in New York City, we're tracking the key players, the major moves, and the capital flows shaping global markets. This is Bloomberg Deals.
Welcome to another episode of Bloomberg Deals, the only show dedicated to the corporate action reshaping markets. Coming up on today's show, as part of its push to compete with NVIDIA, Qualcomm will buy the AI hardware company Modular. It's a $3.9 billion deal. Plus, a turning tide for SPACs. Our investment committee today is stacked with top experts in the space. McNerney, Anna Pinedo, and Betsy Cohen. Will ask them why this year is already seeing a pickup in action. And later, the acquisition some Musk fans are holding out for. Will SpaceX ever buy Tesla? We'll bring you the latest Bloomberg reporting on that. But first, let's get to today's big deals. Qualcomm said it's acquiring Modular for about $3.9 billion in stock, adding AI capability softwares and aiding its push into data centers. Bloomberg's Ryan Gold has been part of the team breaking that story. He joins us now. Ryan, great to see you. What's the thought behind this?
I think this is all about the push into inference. You and I have spoken a lot about the cost and the need to be efficient in terms of how you run models. This is essentially a platform that's going to help take the production, the training of models and put them into live use. And how do you lower those costs? You increase efficiency, and this is through the software. This deal, $4 billion or so in stock, is going to give Qualcomm that crucial software layer that will crucially help it to compete with NVIDIA. This is really the competitive landscape. You want to compete on both the silicon as well as the software. And until now, really, Qualcomm hasn't had that crucial software layer.
I wonder how significant it is that it's an all stock rather deal. And how much of this deal environment, especially for these AI adjacent companies, that they need this, not a bubble, but they need this rise in stock that some people would call a bubble in order to fuel the continued M&A appetite they have?
I think it goes back to really just the cutting edge, the need to get that talent, that drive, and it's really on the cutting edge of AI. For Qualcomm, it's if we don't do this, someone else is going to do this. And when you think about Grok, NVIDIA, Samba, Nova, Intel, and Vista, you can clearly see that the demand is there. And there are only maybe so few of these companies. And so it's really like, if we don't do this, someone else will. And I think Qualcomm sees that.
Well, there's also the Broadcom OpenAI deal today. And Broadcom said that they have a chip that's, I think, about 50% cheaper. So it goes back to where you started, this idea of they're trying to get cheaper compute and cheaper access to this stuff. But how widespread is this cheaper access when these companies are dreaming up these different deals? Is it still really isolated? And are companies still really scrambling to figure out how they can lower their costs?
I think so, and I think maybe this all goes back to a question, which is, given that we're still at the early innings here, you look at Uber driving through its budget. There are going to be many other companies that see this too. It's where you have to get to a point where it starts to go down, not up. Because I think if you're a private equity firm even who's also trying to integrate this kind of technology into their portfolio, how do you make sure that it's not starting to eat into your return? This is a crucially expensive business. We couldn't live without it at this point, but I think there's a bit of soul searching going on in terms of both the efficiency as well as how integral this technology is to running a business.
Right, and you and I have talked about these deploy codes with OpenAI and other private equity firms. We will have B Capital CEO on later in the show who is part of that deploy code. Ryan, thank you so much for joining. Always great to see you. That's Bloomberg's Ryan Gold. Now, elsewhere, SK Hynix planning to raise up to $29.4 billion, tapping investor demand for memory chip stocks. You can get the flavor of today's deals, a lot of AI. The landmark U.S. listing could rank among the top 5 largest share sales ever. Jake Silverman, Bloomberg Intelligence, joins us now for more. Jake, it's a big deal. Why do it?
Yeah, I think for Hynix, really the goal here is to sort of narrow the valuation gap with Micron, because they've historically, not just them, but Samsung as well, have historically had a gap in valuations compared to their U.S. peers like Micron. So this is an opportunity, I think, for investors to no longer see SK Hynix as at a discount to Micron, but maybe trade around something of a more similar multiple than they have in the past. How
should investors be thinking about those multiples? I know you're expecting some big numbers when it comes to Micron's earnings later this evening. It's this whole debate of are these still cyclical companies? Are they not? How are you currently thinking about that?
Yeah, it's interesting because I think one of the conversations I have most with investors is what is the actual right multiple to pay for these companies? Typically at cyclical peaks, you start to see the multiples actually contract quite a bit down to like low mid-single digits. And right now, I mean, if you look at the forward earnings, it's closer to around 10x or so. So the question is really, is that the right multiple? Is that the multiple that investors actually want to pay for it? And do we see potentially more upward earnings revisions where that multiple maybe is actually closer to mid-single digits or so? And then, how much longer does the cycle have to run, as you pointed out? Could we see the cycle run through 27 into 28? It kind of depends very heavily on AI capex and also capacity expansion from the different players themselves.
Well, to that point, and this is kind of what Ryan and I were talking about with the earlier deal of how important it is to be able to get a cheaper cost of capital, to have access to capital itself. What does it mean for an SK Hynix to just bring in more money from a U.S. listing?
I think the real benefit to SK Hynix is that it kind of reduces some of the capital outlays that they're planning in the future. But I don't think that they're really struggling for cash. I mean, if you look at the free cash flow they've generated just over the last few quarters, and if you assume that the memory cycle is going to continue at least through this year and into next year as well, I don't think they're going to be struggling for cash. So I think really the idea of bringing in some additional capital is when they do plan to expand capacity, maybe in the next down cycle, do they burn cash again? It's possible, right? Because that's what we've seen in the past. So, if they bring in, I think it was around 29 point something billion, it basically just, they can expand the capacity by that amount and no longer have to worry about that.
Well, it's that whole thing like raise capital when you can, not when you need to. We've seen a lot of that. Jake, thank you so much. As Jake Silverman of Bloomberg Intelligence, and of course, Ryan Gould from our Bloomberg Deals team. Deal making around the world may be up 32% in 2026 from the same time a year ago. But it's not thanks to private equity. Scarlett Fu has more on how the lull in this corner of deal making is frustrating investors. Scarlett?
That's right. You can blame it on elevated interest rates, market uncertainty, and fears of AI disruption. This backdrop is making it hard for PE firms to exit portfolio companies that they acquired at lofty prices back when rates were super low. And funds that were supposed to return capital and wind down by a certain date, they're staying alive longer than they had planned. Now, according to one survey, the majority of investors in PE funds, known as limited partners or LPs, they now expect these so-called zombie funds to multiply in the coming years. That is up from roughly a quarter of LPs who anticipated this just 2 years ago. And that's left LPs in a bit of a dilemma. Do they push for reduced management fees, or do they press for changes to the fund's terms that would encourage firms to sell investments sooner? One solution is a continuation vehicle, and that is where a PE firm creates a new fund with fresh capital and moves the trapped companies into it. Existing LPs can then choose to cash out or roll their investment into this new fund. The survey, by the way, finds that 2/5 of LPs expect increased use of these continuation vehicles even when traditional exits pick up once again. Danny?
Yeah, I believe they call them creative liquidity solutions. Talk of the town at Superturn a couple weeks ago, along with Scott Kleinman of Apollo, saying some people are going to have to capitulate just for the reasons that you were pointing out. Scarlett, thank you so much. Now, one fund that is not struggling at all to raise money. Sources telling Bloomberg that Abu Dhabi's MGX raised nearly $50 billion to accelerate spending on AI infrastructure and tech. The fund is ranked as one of the biggest AI investment vehicles ever. Bloomberg's Jenny Surain joins us now. Jenny, great reporting from the team. What exactly is the plan with this giant haul they've now brought in?
Yeah, so this is one of the main vehicles that Abu Dhabi is using to go out and invest in AI. And so this is, an Emirate-wide push to kind of be the main investors in this technology. So they've got a plan. That plan will see them invest some $10 billion a year over the next decade as they try to get to that $100 billion goal that they have. I think the really interesting thing here is we've always sort of viewed the Middle East as a source of capital. They have these massive sovereign wealth funds that kind of go out and invest the very PE firms that Scarlett was just talking about. In this, you see them actually kind of flipping that narrative, and they're going out to the different institutional investors that they've long backed, and they're actually saying, no, bring it back. We've got the institutional know-how. We've been the bigger players in this space for a while. Back us and let us show you what we can do when we're at the driving wheel.
Isn't that a big problem then for private capital, who have so relied on these Middle Eastern investors now that they're saying, we're going to stay and we're going to keep this money at home and invest it that way?
I think it will be one of the more interesting dynamics on Wall Street to keep track of in the next few years. I think, it's gone from being a source of capital and a place that bankers fly in and out, every couple of months and come back with big checks. And now it's going to be a much more strategic conversation between these two parties. These governments are becoming more sophisticated. They're involved in almost every deal. They have deal makers, at their beck and call. And so they're able to kind of put this money to work in a much different way. And they're able to kind of cajole these different institutional forms of capital to come along with them.
By the way, does it just feel like all the capital, all these funds being raised are just AI related? I remember John Gray was speaking, I think it was at a Bernstein conference, maybe it was a Morgan Stanley, one of the big financial ones, basically saying if you like AI and you want to invest in AI stocks, invest in Blackstone because we're becoming AI. How many of these big global funds have just sort of remade their image to go all in on AI infrastructure?
I think that's the main theme we're seeing from basically every big institutional source of capital these days. I think it's interesting because you don't just see it anymore as like a tech investment or an equity investment. This is in their infrastructure funds. This is in their debt funds. So basically every senior person at the operating committee level, this is all they're thinking about, and these are the opportunities they're most excited about. And so in that way, it's not such a surprise that you might see them start to kind of flip that script and actually invest in one of the main deal makers that has been in this space for a while now.
I mean, it is notable here on Bloomberg Deals that on a day like today, we're looking at the top stories and it's like, oh, it's all AI related. Yeah. Jenny, thank you so much for joining. Great to see you. That's Bloomberg's Jenny Serrain. Coming up, a new acquisition here in the real world, but it is related to AI. Veolia becomes the second largest hazardous waste management company in the U.S. We talk with the Veolia CEO Estelle Brachlianoff about why the sector stands to grow alongside industrial demand. This is Bloomberg Deals. Veolia is about to become the second biggest company of its kind in the U.S. This month, it announced a $6.3 billion acquisition of Clean Earth, a transaction that will double its footprint in the U.S. hazardous waste sector. One of the leaders behind this deal, or the leader behind this deal, we should say, is Veolia CEO Estelle Brachlianoff, and her company operates in more than 50 countries, giving her the perfect vantage to look at the big picture. And Estelle, I'm so pleased to say, joins us now. Estelle, great to see you. I remember you and I had actually talked in January just about how much of your world was changing because of AI. When it comes to hazardous waste and expanding there, is that an AI play of like some of the hazardous waste that's coming off some of these data centers?
No, you're partially right. It's a double growth play, actually, the Clean Earth acquisition, which is the largest one we've completed since the Suez deal a few years ago. And double growth play because we're investing and doubling down both on the U.S. economy, which is one of the most dynamic one, as well as the hazardous waste business, which is one of the most promising and high demand segments. And why is that so? And this is the link with AI, because there is a high demand linked with the investment in semiconductors, AI, and healthcare in the U.S. in particular, linked with reshoring and everything. And they all are absolutely in high demand for hazardous waste treatment. So yes, there is a link. And we have big ambition for it, as you can imagine.
What are those big ambitions, Estelle?
So for AI is a two-sided coin for us. How do we use it to be more efficient, and how is it a business opportunity to develop our business? So the AI industry, we are aiming at having $1 billion turnover on this by the end of the decade. This is semiconductor industry as well as data centers. We've signed a few, deals already with the big, semiconductor company in the world, in Asia, in the US, and elsewhere, as well as with the data centers, because they all are highly demanding in resource. Everybody thinks about power, but they all need a lot of water. Veolia is a leader in water technologies worldwide. And they all are facing the same challenges with regards, acceptability and local acceptability.
Yeah,
so to get the permit,
there's been a lot of pushback on that. And I think some of the data and your estimates highlight about why there's been pushback. Again, you've pointed out by 2030, the amount of water that these hyperscalers and chip fabs are going to be consuming is as much water as 46 million people. Estelle, are tech companies moving fast enough to address what might be and is likely the coming public backlash to that?
And that's already what those companies have faced. Last year alone, there was $156 billion of project canceled or stopped or frozen because of lack of permitting and planning. And that's partially due to the lack of access to resources. But we have some solutions to make them more sustainable at Veolia, such as recycle wastewater, for instance, reuse the wasted heat to provide in a very affordable way to the local communities, and overall to make them more acceptable to the local communities. That's exactly why we have great ambition in this segment.
When it comes to corporate transformation, Estelle, along with this deal, when it comes to clean energy, you've also planned, clean earth rather, you're also planning to sell about 2 billion euros worth of non-core assets in the next 2 years. Which geographies, which businesses, what are you thinking about what's on the chopping block at the moment?
So overall, you're right. Veolia's portfolio, we are a 50 billion turnover company, Fortune 500, moving very fast to transform our portfolio towards more innovative and tech-driven, as well as more international footprint company. That's why we've invested in the US in hazardous waste with Clean Earth, and we're selling the less growing fast type of activity, which are less interesting and less value added in a way. So this is massive, 3 billion acquisition, and it followed another one last year in water technologies, and 2 billion of divestment. Overall, we will have rotated 20% of our asset base in only 4 years, which is massive. So the company is transforming fast.
Right. No, it certainly is. And it's been really interesting to watch. Where do you find the most receptive audience or buyer for the things you're looking to spin off? Is it public markets? Is it interesting maybe to do a spin off that way? Is it strategic buyers? Is it some of your peers? Is it private capital funds? Where do you see the most interest for some of these non-core businesses?
I would say, before talking about, who could I sell those assets to, the first thing is, I found a lot of high demand for all our services across the globe. And I think it's very, very interesting. The high demand for what I call environmental security, which is to secure the supply of water, to secure the supply of energy, to secure the supply of highly critical minerals, for instance, which is exactly what Veolia does, or even, to reduce pollution and treat pollutants such as PFAS. So that's where we invest the most, and the demand is super high in many countries. And the interest for the assets we sell, usually they are good assets. They are just not growing as fast as where we think we could add the most value added. They could be private equity, they could be other strategic buyers. We have a track record of buying the right stuff and selling the right stuff and delivering on our business plan and creating value for our shareholders as well.
By the way, in terms of buying the right stuff, I should correct myself. I think I might have said the deal was for $6 billion. It's $3 billion. You didn't overpay for it. It was half of what I said. It's $6 billion or more than $6 billion in overall revenue that it contributes.
There was $6 billion. Where you were right is there was a $6 billion in our press release. So $3 billion is the proceeds. But we already have a $6 billion footprint in the US. This is probably worth the two figures for that.
Thank you for clarifying that. And look, this also just highlights, yes, you're doubling down on the US, but you are a multinational CEO. You operate in over 50 countries, and the macro backdrop is complex right now. How are you dealing with rising fuel prices, with supply chains that continue to be interrupted? Where is that hitting your business, and how are you dealing with it?
Oh, actually, we are very protected against a lot of the macro backdrop or the supply chain difficulties, and even tariff when there was a big discussion on tariff. And why is that so? Because we are really a multi-local company. So we really are embedded in the local communities, as well as with a very worldwide footprint when it comes to innovation and patent and investing in technologies. So really, this is the two sides which count to make us super well protected against those changes in the world. Plus, we are really, each time we are in a country, we want to play big. We want to be in the top three. So we're not an observer, we're a big player. And that protects us against, inflation as well, because we have some pricing power. What we do for our customer is well respected and actually critical needs. So the word critical here in today's multi-crisis mode is absolutely essential.
Estelle, thank you so much for joining. Again, it's been fascinating to watch you as you embark on this expansion of Veolia, and we hope you'll bring us other deals to come in the future. Estelle Brachlianoff, CEO of Veolia, thank you so much for your time. Coming up, another wave of redemption requests hit private credit managers. We're going to hear which two firms are the latest to cap investor exits, a story which you are very familiar with over the past few months. This is Bloomberg Deals.
I'm Nora Melinda. Let's take a look at your midday movers. First up, U.S. stocks are rebounding after a tech-led sell-off rattled markets, with investors looking ahead to Micron's earnings report. Falling oil prices and softer housing data are also fueling hopes the Federal Reserve can stay on hold. Speaking of oil, crude is extending its decline, with Brent falling below $75 a barrel and WTI slipping under $70 as more tankers move through the Strait of Hormuz. And finally, Wendy's is surging as retail traders pile into another beaten-down consumer brand. Analysts say the rally has the hallmarks of meme stock mania, fueled by high short interest and nostalgia appeal. Those are your midday movers. I'm Nora Melinda.
Time now for an alternative view. Investors are again seeking exits from private credit funds this week. Two new waves of redemption requests, 11.6% from a fund at Morgan Stanley and 16.8% requests from Apollo's largest non-traded BDC, a credit fund for retail investors. Both those firms, as they promised to do in the documents, capped exits at 5%. Olivia Fishlow has been tirelessly covering all the private credit stories, and she joins us now. I mean, Olivia, it's just a continuation. Should it be surprising that we're still getting in excess of the redemption caps requests to exit these funds?
I don't think it's too surprising. It is what we've expected, that this quarter, the next time of redemptions, that they would pick up again. But I think what we're seeing is the change of the investor base. We're hearing that more U.S. investors or less U.S. investors are asking to redeem, and it's coming from more offshore investors, which I think has been interesting for this time around.
Is that a good thing for these funds, or a bad thing if like more different types of investors are doing this?
I think it's too early to say. I think we'll probably have to wait again until next quarter to see if this trend continues. But I think it does say that every month, even when things aren't reported, the views of investors are changing, even if we aren't seeing it ourselves.
By the way, is there an expectation that this slows down sometime soon, or are we kind of nearing the end of this rush to the exits?
I think it will now start to change fund to fund, because we are seeing as requests move up and more investors are gated, they'll redeem next quarter. So I think we still have some time before it slows down.
Got it. So maybe we'll have this conversation one more time. Maybe one more time. Olivia, thank you so much for joining. Always a pleasure to have you on Bloomberg Deals. Olivia Fishlow there. Up next, something that feels like 2021, are SPACs staging a comeback? Our investment committee gives us an inside look at the latest trends in capital strategy. You're watching Bloomberg Deals. Welcome back to Bloomberg Deals. I'm Danny Berger. Let's go straight to Scarlett Fu, who's been taking a closer look at SPACs, special purpose acquisition companies that saw a big rush during the pandemic. Scarlett?
Yep, and they are making a comeback, Danny. We know that SPACs can allow private companies to go public faster than the traditional route. And right now, merging with SPACs, which are shell companies with cash but no operating assets, might be seen as the better option, especially for smaller companies that want to be a part of the booming stock market but can't compete with mega IPOs like SpaceX, Anthropic, and OpenAI for investor attention and capital. So in terms of volume, here's what the front end looks like. An increase in the number of shell companies going public, 144 last year and 112 this year, with 73 filed but pending. Of course, this is still a long way off from the 613 recorded in 2021, but you can see that it's a steady recovery in listed SPACs. These are now vehicles ready to find acquisition targets. Once the SPACs have found a deal and close on it, we arrive at the back end. And again, 2021 was a high water mark with 199 completed deals. This year, there's a sharp recovery with 20 completed deals and 110 pending, but still shy of that 2021 high. So it's interesting then that when it comes to performance, an index of both active SPACs plus companies that have completed SPAC mergers has now surpassed the 2021 peak. Right now, we see SPACs focused on quantum. Canada's Xanadu Quantum Technologies went public in March following a merger. And on deck, Terra Quantum of Switzerland, Finnish startup IQM Quantum Computers, and Francis Pascal have also announced plans to list via SPAC. So there's that comeback, Danny.
So interesting to see that index there, that's higher than the peak. Scarlett, thank you so much. And that brings us to this week's Investment Committee, where we take you into the boardroom debates in real time. Today's topic, SPACs. Joining us on today's IC, Christine McNerney. She's portfolio manager at Periscope Capital, where she specializes in SPAC and ECM strategies. Anna Pinedo, she's global head of the Capital Markets Group at Mayer Brown. She also helped write the book on raising capital, corporate finance, and security laws. And we're thrilled to have with us Betsy Cohen. She is chairman and co-founder of Cohen Circle. She is a pioneer in SPACs, has more than 50 years of experience running companies and investing across capital markets. Thank you all so much for joining. Really thrilled to have you. Betsy, I got to start with you because you know the SPAC world really well. You were one of you're a legend in SPACs, I think it's fair to say. What makes this class different? 2026 volume is starting to pick up. What makes 2026 different than, for example, when we saw the other high watermark of 2021?
I think that people understand that it's not a slam dunk, so to speak, that it takes a certain amount of skill and knowledge and knowledge of the capital markets in order to complete a SPAC. There were a number of SPACs that commenced during 2021 that never could complete for a variety of reasons. And so both the sponsors and the investors are much more cautious and maybe more knowledgeable.
Would you agree with that, Anna, that what we're seeing now is a more cautious SPAC investor and SPAC groups?
Yes, we're seeing SPAC sponsors that are significantly more experienced, and we're seeing SPAC sponsors that are repeat SPAC sponsors, so that certainly brings the experience that Betsy is talking about. There's also the benefit of SPACs coming to market with the amendments that the SEC adopted to the SPAC, IPO, and de-SPAC regime. So that brings certainty that we didn't have in the 2021-2022 market timeframe, and that's important. There's also a slightly more favorable view towards SPACs in the current SEC administration.
Do you think, and Christine, let me bring this to you, given all of those, what is the reasoning why you think that volume has been picking up last year and this year, after we saw, again, just 2021, huge amounts of volume, crashes pretty significantly? Why are we back on the up and up?
I think that SPACs work really well for a certain type of transaction. Obviously, in a traditional way, IPO, you can't give projections, but in a SPAC you can. So if you have a company that's evolving, shifting, growing rapidly, then it can be really beneficial to have that projection and that forward-looking statement. So we're seeing a lot of growth and topical interest in things like AI, data centers, quantum, as you guys already mentioned, and that really benefits from that, the forward projections, because the companies are going to look really different in 5 years than they look today. So the SPAC is a really good product for bringing those companies public.
Christine, could you outlay just where Periscope invests and exists in the SPAC universe? Well, what are the interesting opportunities for you right now?
So Periscope participates through all stages of the SPAC ecosystem, from early stage risk capital transactions all the way through de-SPACs. We're seeing a lot of really interesting things, both on the IPO side and the de-SPAC side, in particular the AI and data center build out. Those are sectors that are going to require a lot of capital, and they're going to require it relatively quickly. And there's significant demand in the area. So it really works well with the SPAC structure. And we're seeing both de-SPACs happening there. Boost Run is a really good example of that. And also a lot of IPOs that are going to be seeking in that region.
Betsy, you've been a serial SPAC sponsor in this market, and I think it's fair to say one of the most respected of that. What do you think the big opportunities are right now?
The SPAC is just a legal vehicle. It, as Christine said, is good for some companies and not for others. It was initiated in the 1990s for the steel companies. They couldn't raise money, and this was a way for them to proceed and to infuse capital. We now have a whole different group of companies that need capital, whether it's data centers or nuclear stations or AI or evolve anything that you might think of that has a capital, deep capital and continuing capital need. And these are the countries that are going to go to the public markets because it gives them the window to continue to raise capital. Today, you mentioned quantum. Quantum is certainly one of the areas in which there is a deep, deep need for capital in order to get the quantum universe up to an application stage and therefore revenue generating. So there are a variety of opportunities. A lot of them are in technology. You know, we've just seen the mother or father, depending upon your point of view of it all, you know, in SpaceX. SpaceX has been continually a capital raiser in the private markets and very successfully so. But it then matured to the point where it could, in fact, be predictive, and that allowed it to become a public company and to access those public markets.
I mean, Anna, Betsy makes an interesting point, just comparing it, you know, SPACs coming back with some volume and just the IPO market coming back in general. Does one cannibalize the other? Like, is it problematic to have successful IPOs coming back and companies maybe saying, I can go that route, I don't need to, you know, go to a SPAC and have that SPAC de-SPAC?
Not at all. They complement each other. In fact, I think that the resurgence in SPACs is in part due to the fact that there is an attractive IPO market. And I think there's a certain part of the resurgence in SPACs that we can say is because there's a healthy IPO market. That provides a little bit of an incentive or some exuberance or enthusiasm to founders and to boards of target companies, private companies that see that and that see that the equity markets are alive and well and receptive to good companies. The IPO market may not necessarily be available, to Betsy's point, for companies of all sizes. Some may have to approach the market through a combination with a SPAC. And I think many companies are agnostic whether they go public through a combination with a SPAC or do it in a traditional IPO.
It does seem like just, you know, we've all mentioned quantum, actually, to be fair.
Yes.
And Christine, I just wonder, is there space for companies to be targets of SPACs that aren't quantum, that aren't AI related? Is there any room for like a more sort of traditional type company that maybe, again, has that high capital need, but doesn't exist in the AI infrastructure quantum sort of ecosystem?
Definitely. I meet with de-SPAC targets very regularly, and sometimes I come out of the meeting, I say, you know, what a boring company, but I mean that in such a positive way. You know, they have steady revenues. They might not be, you know, the next big quantum or AI or robotics thing, but they're, you know, a stable, steady company. And, you know, we love to see them go public through a SPAC. It just adds more credibility to the market when they do that.
I only have about, you know, less than 2 minutes left. So I just want to quickly, I would love to get a sense check from all three of you. 2021 was the high watermark. Can we ever get anywhere close to those types of levels? Betsy, let me start with you.
I don't think we should. You know, we're not doing this in a vacuum. We're doing this in the context of external factors, and the market, as Anna said, is certainly a critical one.
Right.
I don't think we need to get back there. We need to move forward with high quality sponsors, knowledgeable individuals, companies that have performance either ahead of them or behind them. And so I would say that's not a goal I would like to reach.
Anna, would you agree with that?
I agree. I do think it's important to flag that the SEC proposals rolled out just recently on registration reform favor SPACs. They would make it possible for SPACs to have a shelf sooner. So they make SPACs a more positive alternative.
Okay.
So good news for SPACs.
And Christine, let me wrap it up with you. 2021 high watermark, not something we should really be aspiring to?
No, we don't need to go back to that. We have a much more disciplined group of investors and group of sponsors. And, we really learned in 2021 that credibility matters much more than hype. So I think the SPAC market's at a healthy point right now, and this is probably a good level for it to stay at.
A perfect note to end it on. Thank you so much to today's investment committee. That's Christine McNerney, portfolio manager at Periscope Capital, Anna Pinedo, global head of Capital Markets Group at Mayer Brown, and Betsy Cohen, chairman and co-founder of Cohen Circle. Up next on the show, despite the amount of capital being thrown at AI building out, investment firm B Capital believes that AI remains underfunded. We're going to talk to the co-CEO about why he believes that. This is Bloomberg Deals.
We're just about halfway through the trading day in New York. I'm Nora Melinda. Let's take a look at your midday movers. First up, U.S. stocks are bouncing back from yesterday's tech-driven sell-off, with traders turning their attention to Micron earnings out later today. Lower oil prices and softer housing data are also helping support hopes the Fed can remain on pause. Meanwhile, oil prices continue to retreat, with Brent falling below $75 a barrel and WTI slipping under $70 as more tankers move through the Strait of Hormuz. Among individual movers, homebuilders are having their best day in nearly a year after Congress passed a broad housing bill aimed at lowering costs. This comes despite President Donald Trump threatening to withhold his signature, putting the bill's future in question. And finally, Cerebras is tumbling after issuing a sales outlook that fell short of expectations, disappointing investors who'd hoped the AI chip maker would capture a larger share of the data center market. The company went public back in May, and its CEO joined Bloomberg TV earlier today.
We're ahead of plan. We delivered record revenues of $191 million, up 92% year over year. And for our cloud business, it was up 167% year over year. We beat margin consensus substantially. And then we guided for full year the gross margins would be 10% better than planned.
Those are your midday movers. I'm Nora Melinda.
You are watching Bloomberg Deals. I'm Danny Berger. B Capital is an investment firm with over $12 billion in AUM that has invested more than 200 companies globally with a focus in tech, healthcare AI, and energy AI. Raj Ganguly is the co-CEO of B Capital and believes enterprise AI adoption is driving the next phase of value creation. And I'm so pleased to say that Raj joins us now, visiting New York City. Raj, great to see you.
Great to see you.
And look, I think your investments are so interesting. Yes, you do have some of the models like Perplexity, but I feel like yours is an industry, VC in growth, that has done really well because of like an Anthropic investment or OpenAI. Why go into kind of the more, the different sort of ecosystem and not necessarily put all your eggs behind like the foundational LLMs like a lot of your peers have tried to do?
I think the foundational LLMs are really important. We're an investor, as an example, in Reflection AI, which is an open source LLM that really competes with some of the foreign open source LLMs because we think it's really important to have open source. But one of the reasons that we think open source is important is because of the enterprise. We think enterprise AI, that large enterprises want to be able to have access to not just the closed models, but to open models. They're more cost effective, they can be customized. And that's why we've really focused on things that drive AI at the enterprise level.
See, that's really interesting to me, this idea of cost, because it has been this bubbling up problem that people have started to talk about. The Information had a story earlier this week just talking about like the skyrocketing use of open source models. Do you think that that will only continue, or do you think Anthropic, OpenAI, Gemini will find ways to like bend space and time and make everything cheaper for their users?
Listen, I think that Anthropic, OpenAI, Gemini are amazing companies, but I also believe that there's space for these open source models, they're a fraction of the cost. The tokens are much cheaper. And frankly, you could just really customize them. And ultimately, probably the most important perspective we have at B Capital is the models keep getting better and better, but it's the contextualization of the model that matters. And so we need to spend more time molding AI into the enterprise and not just building better and better models toward AGI.
What does that mean of how you're viewing software and software investing right now? I was down in Berlin with Orlando Bravo, who was like the SaaSpocalypse, which is a horrible term to begin with. It's over, it's dead, it's not happening anymore. I mean, can you invest in software for the enterprise right now?
Listen, I think the use case of software is fundamentally not going away. And there's a little bit of a belief that we're all going to build our own software and therefore we won't need enterprise software. I'm a bit skeptical of that. I think enterprise software, the use case will remain. Yes, there will be some cases where you will build your own software. But really what we need to see is that those enterprise software companies become AI first. A big example of this is if there's a 3-day training to learn how to use an enterprise software, that software is not going to work. You need to be intuitive. The way that chat is intuitive, you have to be able to sit down and use enterprise software with no training, and that's where I think AI-first companies have done incredibly well.
By the way, when we teased you before the commercial break, we basically said that B Capital has this view that AI is underinvested. How? I mean, so much money is being thrown at this thing. Where is AI being underinvested?
I think it's in traditional companies. As an example, you look at places like financial services, and financial services is an area where they are adopting AI, but I think the scale with which financial services will get transformed with AI, we're just starting to understand it. There's trillions of dollars of assets that, frankly, are still being managed in a very old-fashioned way. And where the investment needs to happen is, I think you'll see venture and private equity firms really investing and purchasing traditional companies and focus on the AI transformation of those companies, because we all learned in the 90s and early 2000s that fintech didn't mean that banks went away. It just meant that banks learned how to use fintech better. And I think this time around, you'll see financial service companies that adopt AI can actually be the winners.
I mean, everyone is talking about this idea of trying to transform companies. How many people in your industry do you think actually get it and are going to be successful at that?
It's really tough because the private equity firms have been doing transformation for a long time. I'm not sure if they have the AI chops, and the venture capital firms are really good at AI, but owning and managing companies is much more than the AI. There's the people aspect, there's the governance aspect, there's just other aspects of growth. So I think you'll see the lines between venture capital and private equity blur. And I think it's an exciting time to be where we are today.
By the way, what do you think happens? Because we're about to get more IPOs. We already had SpaceX, but we're going to have more AI IPOs with OpenAI and Anthropic. What do you think happens to VC that gets those proceeds back? How do you think it will change the ecosystem?
Well, it takes 6 to 12 to 14 months to get those proceeds back. That's incredibly healthy. We've had a bunch of IPOs. We were an investor in SpaceX as an example, but it takes a while for that money to come back around. And what we're hearing from our LPs, from the institutional asset owners, is that they're really appreciative that those proceeds will come back, because that's what makes the venture capital and private equity ecosystem work. And for the last 4 or 5 years, that circular ecosystem hasn't worked as well.
Are you like us? You wake up every day and check what SpaceX share prices are doing? Or are you I don't want to look, I can't see it?
We're, as private equity venture capital investors, we take a long-term view toward these things.
Fair enough.
So I don't check it every day. It does pop
otherwise,
up on my
Otherwise,
feed.
you'd be a public market investor. Raj, thank you so much for joining. Great to see you today. That's Raj Ganguly, B Capital co-CEO. Coming up, more on SpaceX, that landmark debut. Maybe we'll get Raj's view on this in the commercial break. Giving Tesla employees the fear of missing out is a merger, Elon's ultimate plan. This is Bloomberg Deals. Welcome back to Bloomberg Deals. Danny Berger here alongside Scarlett Fu. Tesla investors holding out hope that Elon Musk's ultimate plan for is a merger between Tesla and SpaceX. That combo would create a massive tech company and could become one of the biggest on the market. Bloomberg's Carmen Arroyo covers tech and joins us now. I promised the audience I'd ask B Capital's co-CEO in the break what he thought of this, and he was like, duh, of course. This makes so much sense. What difference does it make to have SpaceX selling off and be public now? Does that make this more likely?
Well, I feel like the whole stock market is really betting on this, and Tesla investors have been thinking about it for a long time. the companies already work together a lot. It's already like a very intertwined conglomerate. So everyone is kind of assuming it's going to happen soon, and it would make a lot more sense if you're an Elon fan.
Tesla buying SpaceX, SpaceX buying Tesla?
TBD. I guess people assume SpaceX buying Tesla, merger of equals. It's TBD.
I guess my co-anchor for Open Interest always says there's no such thing as mergers of equals, but I mean, the man owns both of them, so what difference does it make? Carmen, so great to catch up with you. Thank you for bringing us that story, Bloomberg's Carmen Arroyo. And that does it for Bloomberg Deals. And stay up to speed even after the show. Subscribe to the Deals newsletter. See you same time, same place next week. But up first, Balance of Power, live from Washington, D.C.